Okay, good morning all. Good morning. Just going to give you a few seconds to enter the room and we'll get this underway. I'm actually a minute early, so we'll soon find out. All right, so once again, good morning, traders. So as evident from the slide, today's presentation is all about news trading. Now, while this is still debated, trading based on the economic calendar is a tactic many short-term and some swing traders do employ. Now, I'm certainly not here to say that your trading approach is better or worse than mine or another traders, but just hear me out today and then decide for yourself. Many moons ago, I fell firmly into the bucket that around news time is a dangerous time to be in the market. You know, liquidity is thin, and I did not really want any part of it. That was, however, until I was shown how to correctly view economic indicators, and it really changed my perspective on the whole approach. So as I said, give me a little bit of your time, maybe 30 minutes, and then decide for yourself. If you feel news trading is fit for the bin after this, then that is absolutely fine. As what works for trader A may not work for you and me. So as a way of an introduction, my name's Aaron Hill, and I am one of the market analysts here at FP Markets. As usual, there should be no issue with the sound or the slide deck, as these were double checked before going live. Do be sure to let me know if you are facing any issues, however. It's fine to fire across any questions you have during the presentation, but if you really feel it's something that may require a more detailed response, please consider waiting until the end of the presentation, as we may clear up any questions as we proceed. As usual, quick disclaimer, this is not investment advice. This presentation does not constitute investment advice. It's purely an educational presentation. Now, as you can see, the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. Once again, guys, this is not investment advice. This is purely an educational presentation. Okay, so in terms of content, as you can see here, we are going to define what news trading is. And then we will discuss whether news trade, or you hopefully by the end of this presentation, you will know if news trading is right for you, or if it's something you want to explore further. We'll then look at how to create your own news trading strategy. Now, primarily, I am going to be only looking at really two key approaches, that being trading into the event and trading out of the event. Also, a technically based strategy I will briefly highlight. As I say in all my webinars, in terms of questions, if I miss any, or those that, as I said, require a more detailed answer, you can email me and the research team at marketanalyst@fpmarkets.com. Or support@fpmarkets.com. I will throw a link in the chat box for you guys. Just bear with me. You should all be able to see that email. That's direct to the research team, and that's probably the quickest way to get a response. Also, please do feel free to send across any topics you wish us to cover in future presentations. Now, on the screen, you should see my client portal. My client portal. So if you're a live trader with FP Markets, you do have access to a host of trading tools. One being, if it works, I'm sorry about this, guys. Let me re-signing. All right, so one being the Trading Central. So this is a new addition for FP Markets, and it, as I said, it really houses a suite of indicators for us to work with. So the one we're going to be working with today is referred to as economic insight. As you can see, monitor, anticipate, and act on market moving events with impact and volatility analysis. So this is the calendar that you'll be presented with. You can use, so I always have mine switched to this week so I can see the whole week in advance. You can also use the necessary filters. I won't go over in too much detail with this, but the importance, low, medium, and high. So that is the type of events you're looking at. Just bear with me, guys. Just bear with me. So look, I am going to assume that we are all familiar with the economic calendar. As you, of course, you will need to be able to trade. You will need to be familiar with this calendar to be able to trade with economic news data. So briefly, an economic calendar is a place that informs, traders, investors, economists, and whoever else has an interest in the economic, shall we say, well-being of a country's economic landscape. What it does in a straightforward manner is show scheduled news events in relation to the economy and the financial markets. Do note that you will hear some analysts refer to news events as economic data or even risk events. Now, a risk event is really any economic data point. So let me just scroll down here. Is really any economic, let me just get to the most recent data here, is any economic data that that could affect the financial markets. That's quite simply all a risk event means. As you can see on the economic calendar, an indicator, just bear with me, this should be, here we go. So an economic indicator is data for a particular country, for a specific economic indicator at a specific time and date. With it, you will have your, let me just find a key one. So let's look at the initial jobless claims. So the initial jobless claims, with the economic indicators, you will have what's known as the actual number. Now, the actual number is only released, of course, once the economic indicator is released. So you'll only have the actual data once it's released. Now, forecast and previous numbers, as you can see here, I hope you can, we have a forecast value at 187,000, and the previous was 186,000. So you would always have these with the data. Very rarely do you not have this data with economic indicators. Of course, when you're looking at central bank speeches, you will not have previous or forecasts and things like that because they are speeches. So just to be clear, on the Trading Central calendar, if it's marked red, that implies a potentially high volatility in the market at this time for this event. Of course, this is the ECB interest rate decision for today. We also have the BOE interest rate decision. It should also be showing here, but it's not. I'm unsure of why that is. Excuse me. But yeah, we do have the BOE and the ECB up to taking the stage today. But anyway, high impact marked in red. Medium impact marked in a dark gray, and then we have the low impact, potentially low impact, marked in basically a very light gray color. So economic indicators, as their name implies, often on our statistics, often on a macroeconomic scale, and really they're designed to measure economic activity. So we use these indicators to analyze as I've said, the well-being of a country's economy. Now, government organizations and private groups release several economic reports on a weekly, monthly, also quarterly basis, each measuring activity in a particular segment of the economy. Now, I'm sure most of us are aware, but widely followed indicators concentrate on employment, inflation. Think of the consumer price index, the producer price index. So you have CPI and PPI. We have growth data, which is the gross domestic product. We also have retail sales. Now, another thing, another couple of economic indicators I really think that deserves a note here is, of course, industrial production and, of course, housing figures. Now, housing figures are incredibly important at this time. We also have the stock market. That's a leading indicator of the economy. So we can also view the stock market. Now, just to be clear, no single indicator here can provide a clear picture of the country's, the economic health of that country. At best, each indicator provides what's known as a snapshot of current conditions. But when we piece together the economic indicators, you should really derive a clearer picture of how the economy is faring. Now, it is crucial to understand that some economic indicators are more important than others at certain points in time. Now, I'm sure this needs no introduction, but inflation, as of now, is incredibly important. Other economic indicators to watch can be found on the statements from central banks in their forward guidance. So this is what the central bank are watching, and this is what you should be watching closely too. Now, that was, of course, until most central banks switched to a meeting-by-meeting approach. Now, I will talk about this a little bit in a couple of minutes. So, to be clear, a trader, as a trader, be it short term or long term, the economic calendar is essentially one of your best friends. Although it will only take a few minutes, traders, again, irrespective of one's trading style, should monitor the economic indicator, the economic calendar, as events can essentially influence a trade's outcome. So what do I mean by this? If you're a short-term trader, a short-term day trader, and you focus solely on the technical landscape, you do not include fundamental analysis whatsoever. What you will find is many technical-based traders will still look at the economic indicator, economic calendar. For instance, they have the high impact events. They will note the high impact events. They will potentially note the medium impact events as well. So these are times when volatility can increase, liquidity can thin, and price movement can gyrate incredibly aggressively. So in terms of the calendar, in addition to actual previous and forecast numbers, which I showed here, just go over this once more. So let's go with the initial jobless claims today. So we have the forecast number of 187,000, and we also have the previous number. So this is the previous number, the previous weekly number in terms of initial jobless claims, and that's about 186. So look, the market is expecting basically a no change. So they're expecting nothing to really change in that previous week. Now, we also have to become accustomed. If you're going to work with the economic calendar, you have to become accustomed to the dates. And these, of course, can be confusing for the newer traders. We have things like year over year, month over month, quarter over quarter, and of course, year to date. Just bear with me here. All right, so annual or year over year, as you might expect, is simply data compared with data a year prior. Nothing more, nothing less. So I'm just going to try and find us a year. We probably won't find a year over year measure here, but just to be clear, if you see YOY, this is simply data that's compared with data a year prior. Now, the main ones you will get are the Q/Q, the QOQ. I think I just saw one on the calendar here. Here we go, the QOQ. So this is a quarterly measure. Now, what this represents is data compared with the previous quarter. Again, nothing more, nothing less. It's data. It's the quarterly data compared with the previous quarterly data. We also have month over month. Now, we do have month over month somewhere here. I did see this. Here we go. Factory orders, month over month for December. Again, all this is it represents monthly values compared with the previous month. Nothing more, nothing less. So year over year compares data with data a year prior. Quarterly over QOQ, or quarterly data, represents data compared with the previous quarter, and month over month data represents monthly data compared with the previous month's data. Now, this is where it might become a little confusing, is you will find common year over year comparisons that include annual, quarterly, and monthly performance. So I don't see anything really on here, so I will try to explain this as best as I can. As an example, we could be measuring, so if we're looking at year over year comparisons on a monthly basis, what we are doing then is we are measuring, say, December's data against December's data compared with a year ago. That's the monthly performance compared with a year ago. You can also simply say that we are measuring data in the 12 months to December. Similar for quarterly data. What we are doing here, quarterly data over an annual basis, what we are doing is measuring the quarterly data compared with a year earlier, compared with the quarter a year earlier. Now, you will see a lot of Chinese data have labels like Q/Y. This data represents the quarterly value compared with the quarter a year earlier. Now, these are things you need to be aware of if you're looking at the calendar. Now, another date we need to be aware of is year to date, or YTD. Now, this refers to the period extending from the beginning of the year to the present date. That should be pretty much self-explanatory, but you may also see some indicators labeled as YTD/Y. Mainly, I see these with Chinese economic indicators, but what this really tells us is it's the year-to-date investment compared to the same period a year earlier. You may also see on some calendar events something like 3M/Y as well. Now, all this really represents is the 3-month moving average compared with the same period a year earlier. Now, this can be seen in a number of different countries, including the UK data. So just to really recap here, we have year over year, we have month over month, we have quarter over quarter, and we have year to date. Now, again, common year over year comparisons include, of course, annual, quarterly, and monthly performance. Look, if there are any questions, please shoot them through now, and I can address any questions at this point regarding this. If not, I will shoot back to the slides. All right, excellent. So let me shoot back to the slides. Okay, so now we have an understanding of the economic calendar. What is news trading? So at its simplest, news trading is essentially the practice of formulating strategies that involve economic economic data, excuse me. So I think it's very important to understand that the excitement of trading news usually overwhelms newer traders. And really what it does is it overwhelms their sense of logic and good sense. Now, of course, trading the news for new traders is a big mistake. The news should only be traded by really traders who are used to it through repetition. Now, I'm sure that for anyone that has tried to trade the economic calendar has, particularly when first starting out, found it to be an incredibly frustrating endeavor. You will, if you're not tuned into, excuse me, just bear with me, guys. You will, if you're not tuned into both the market's expectation, excuse me, guys. Just bear with me. Okay, apologies. So if you're not tuned into both market expectations and the economic picture, you will likely be thrown back and forth until you or your account balance can no longer function. So just to give you an example here, sometimes news trades, they take off and move in one direction. And sometimes there is even a stop run before this occurs, and then it moves the other way. And sometimes there is even a mean reverting movement, which usually sets up the charts for a longer term, a movement on the longer term horizon. Now, as you can see here, first and foremost, we must understand that price movement is based on expectations. So what do I mean by expectations? So really what I mean is that if an expected event or an expected outcome of an event, do you remember from the calendar we just showed there? The forecast is your expected, the expected outcome of the event. So let's say we're looking at the non-farm payrolls in the US. Just to be aware, guys, this is out on Friday. So yes, we are now looking at the non-farm payrolls in this example. So if the expected outcome of the events generates the expected outcome, so it's in line with market expectations, the immediate aftermath or the post-event volatility will likely be limited. However, if the outcome of the event is unexpected, so it deviates from the expectation. So think that a higher than anticipated NFP print unfolded. This would therefore see a more violent reaction as market participants readjust their expectations. Now, to be clear, there are a number of ways one can trade the news and devise strategies, though here I will focus on only a handful of what I believe to be key approaches. So ultimately, those who trade news releases attempt to profit by taking advantage of the, shall we say, the market sentiment leading up to the release of important news, and or trading on the market's response to the news after the fact. Now, forward guidance. Prior to global inflation, central banks offered what was known as forward guidance. Now, this essentially informed us what indicators, of what indicators to monitor alongside the central bank. Now, most major central banks, however, have now adopted a data-dependent approach. Essentially, they follow a meeting-by-meeting method, as central banks, they really did, if you remember from when inflation began increasing, they really were surprised by kept being surprised by the data, which really affected their credibility. So an important point to remember is if you're considering trading central bank meetings, so think of the FOMC, the BOE, the Bank of England, or the ECB, European Central Bank, it is not the same as trading an economic indicator, as there can be more variables to take into account. For example, the FOMC and the ECB have press conferences 45 minutes after the release of the statement. And it is here that price action can also see some exceedingly serious chop in price action, or whipsaws. As the press conference usually has unscripted answers, unscripted responses to questions, and all that good stuff. And this can really play havoc on the currency markets. So just what is buy the rumor and sell the fact, or sell the rumor and buy the fact? I'm sure some of us have heard of this phrase. This is important to understand and really serves well as an introduction. Now, just to be clear, the rumor here, the rumor is not inside information or anything of this kind. This is information known by all market participants. Really, what it means is the anticipation and trading of an event. So as a very basic interpretation, we can think of a major central bank's decision to raise or cut rates. The expectation of the event is widely available for all to see. Now, on that calendar I just showed you there, that we have the ECB interest rate decision, and the forecast is 3%. So we're forecasting a 50 basis point increase. This is what I'm referring to when I say the expectation. These are the market expectations that are known by all market participants. So the expectation of a central bank raising their interest rates will generally underpin that country's currency in advance of the anticipation of that event. And assuming the release is as expected, there will generally be a pause in buying. So what I'm saying here is prior to the event, prior to that event where the central bank is anticipated to hike its interest rates, the advance into that event is what I'm referring to as buying the rumor. And again, assuming that the release is as expected, there will generally be a pause in buying and maybe even a modest correction, which really rounds us off to the sell the fact part of the phrase. And what this does is it erases some of the earlier gains leading up to the event. So why does this happen? Why do we see a buy the rumor, sell the fact, or sell the rumor, buy the fact? Well, in the case of the central bank anticipated to hike rates, if traders are buying based on that example, buying into that event, who will be left to buy the market after that event is released? Collectively, bids in the market, therefore, could be weak and a down move could materialize. So if we think about it like this, those buyers who bid the market in expectation of a central bank hiking its policy rate were only in the trade for that specific event. Once the event is released, assuming it's released as expected, a collective correction could emerge as traders cover their long positions. Of course, this is not saying that these traders will be the only traders in the market. There will be, of course, other traders in the market for different reasons. But for this particular event, it should now make sense why we see this kind of market action. So buy the rumor and sell the fact, or sell the rumor and buy the fact. Now, just to be clear, though, this is not always the case. Price does not always top out following the release as expectations may not be met. So the first and most obvious news trading strategy then is what's referred to as trading into an event. Now, simply this involves assessing as you can see here, the expectations and economic position prior to an event. Now, similar to buying the rumor and selling the fact, this will provide the basis for trading into a news event. Now, the expectations again, or forecasts, are available on most economic financial calendars. You can use Forex Factory, you can use Trading Central, as I showed. These will all provide you with forecasts, but you will also, with some major institutions such as Reuters and Bloomberg, what they do is they provide you with not only the forecast, but they also provide you with what's known as a forecast range. Now, what you usually see on the economic calendars, the free ones especially, is the median expectation, which is simply a measure of location that locates the midpoint of a batch of data. So it's essentially the central point of that forecast range. But with the forecast range, we can see the entire batch of data from the extreme high forecast to the extreme low forecast. So if you can get your hands on this, fantastic. This will help you determine whether an event is, deviated from expectations. It will help you, but you can rely just on the median expectation. So let's focus on the FOMC, the US inflation situation, and of course, yesterday's FOMC. So inflation, since its peak in June last year at 9.1%, we have seen 6 consecutive months of slowing. We now have inflation at 6.5% in the US, thanks to the latest release on the 12th of January, which, although has shown a downside direction, it is still 3 times the central bank's target. Now, ahead of the inflation release, the median expectation was actually 6.5%. So the release came out exactly as expected, and the sell-off into the event, if you look at the dollar index, the sell-off into the event prior to the event on the 12th of January was justified in this sense. And also, if you check the M5 chart, the immediate aftermath of the event on the 12th of January actually saw a spike higher, followed by a small dip lower, but it did correct to the upside over, I think it was the subsequent hour. As traders and investors, think about this, as traders and investors cashed out of their short positions following the release. So what they did here was sell the rumor, they sold into the event and cashed out of the event. So they sold the rumor, bought the fact. So shorting prior to the event here, as I said, we are effectively trading short based on the expectation that inflation will continue to slow, and consequently, the central bank will continue to slow its rate hikes. And this really highlights something that's put around the financial news a lot. Good news is bad news. This is something that you will see a lot going forward, I believe. However, it has been the consensus for some time now that given the slowdown in inflation, that the FOMC is going to begin pulling back on its rate increases. And this is exactly what we've been seeing. The expectation of the Fed slowing the pace of policy tightening has, of course, added weight to the dollar's downside. And this is why I believe the US dollar, if you look at the US dollar index, it's in a downtrend now, especially on the daily time frame. Not so much the monthly time frame. We are still in an uptrend there. But it's struggling to catch a strong bid right now. Again, this is because a slowdown in the, just bear with me. So this is due to, sorry guys, I got completely lost there. I'm so sorry. This is due to the inflation slowing, and of course the central bank anticipated to cut back on policy tightening, and therefore the dollar is struggling. So the bottom line really here is that in order to trade into an event, to trade prior to that event, the market expectations for an event, as you can see here, must support the economic picture, must support the economic picture for that currency. So in the case of the example, again, with the US inflation, traders will only short the dollar ahead of the lower than expected inflation release if market sentiment is negative and is unlikely to be modified in the near future. So look, given that the Fed are now expected to slow interest rate increases, this is plastered all across the internet, guys. Many news sites are commenting on this. And the Fed are expected to eventually pause their rate hike. So that's the terminal rate. We can expect the dollar to fall in price, leading up to the risk event with a lower than expected forecast, which in this case was inflation. Now, if the economic landscape is healthier and the inflation release still forecasts a slowdown, this will be difficult to trade into. Trading into an event, as far as I'm aware, is only really achieved when the economic event harmonizes with the overall market sentiment. Now, this is where we can look at another potential news-based strategy, which entails actually trading out of an event, or what some may refer to as trading out of an event or trading during the event. Now, of course, this is slightly different to trading into an event in the sense that we are looking for the events to be opposite. So what do I mean by this? Market consensus will still be needed. You'll still need to know, sorry guys, you'll still need to understand what the median projection is for the event, as you will also need to understand the economic picture for the currency you are trading. So let's change things up here slightly, and imagine US inflation is expected to slow at 2%. Slow to 2% in December. The current rate, the current inflation rate, let's say, is 2.5%. With that being the case, imagine if we see things shift to. But look, just to be clear, the difference here is we are trading out of a risk event, so we would need the overall market picture for the dollar to be healthy. In this case, we can think of the Fed being expected to push up its interest rates while inflation is looking to punch lower. This is where it gets interesting. So with the US inflation print expected to come out at, say, 2%, a lower than previous number, imagine that things shift and we see a 3% release figure for that inflation. Now that beats both the economists' median forecast and the previous number. What could happen in this case is we see a strong, forceful dollar bid. And this will, of course, weigh on other currency pairs, such as the euro dollar and the Aussie dollar, for example. So in this scenario, we could even see stocks sell off and bonds take a hit as traders price in the possibility of much more aggressive rate hikes. This can provide very nice trading opportunities when this occurs, as the release now aligns with the market sentiment. So again, it harmonizes with market sentiment, but prior to that, it did not. As you remember, we were looking at a lower than expected number in inflation, but the event surprised markets and aligned with market sentiment. Now, another quick one I will go over is central bank policy divergence. Now, I won't go into too much detail regarding this, as I will be focusing on this in next week's webinar. So a key trading principle in the FX world is trading a strong currency against a weak currency. So what we are looking for here is a policy out of one central bank to support a currency by hiking rates. So, and assume the other central bank. So assume we're trading the euro dollar. The ECB is looking to hike its interest rate and the Fed is on pause. That should underpin the euro dollar, or should help underpin the euro dollar. What about even if both central banks are slowing their pace of hikes? What do we do in this case? So if one is slowing faster than the other one, the slower of the two could provide support for one currency over another. Now, this is a trading strategy, I believe, that will suit swing traders. Again, I will not go into too much detail regarding this, as it will be part of the swing trading session next week. Now, if we're just looking at news to trade with on a purely technical basis, so this is something that I used to fall firmly into this bucket. And to be clear, I do still know traders that trade news purely from a technical perspective. Now, let me explain. I'm just trying to find the pen here. There we go. All right. So, I'm just trying to think of the best way. So look, if we base a news strategy just on technical analysis, I would not recommend trading during the actual news event. So for instance, the ECB is set to release its interest rates hike or at 1:15. I would not recommend trading during that time if you're trading purely based on technical analysis. What I would do is wait for at least 30 minutes post-event to trade technically. So what I mean is so let's put it this way. What I mean is if say US inflation data, the release could trigger strong market movement. Now, expecting a technical level to actually be respected during that time is not something I have really seen work, although it surprisingly does at times, but not enough for me to have confidence in the strategy. However, again, what I've seen is it's common for traders to say wait for at least 30 minutes post-event to trade technically. Now, this could be following a breakout of a so imagine the event is here. We see a strong move to the upside based on that event. What you'll see is price then step lower, gradually step lower over the 30 minutes. So this is imagine this is a strong, well-placed resistance level. It's common then to see traders, technical traders, trade the resistance, which is now turned support. So you would wait for the event to occur. You would then reassess the entire technical picture to see whether a trading opportunity does exist. Now, this is a very, very basic technical-based strategy. You can also use moving averages. You can also use trend lines. You can also use the RSI. If we're strongly overbought or we're seeing clear divergence, negative or positive, we can trade based on that. You can use Bollinger Bands. They measure the volatility of that time for that market that you're trading. You also have things like other indicators like momentum indicators based on stochastics, the MACD. You can use all kinds of things, but it will be up to you to decide how to technically trade the news. So as I've said, this is a very, very basic example, but you could also use this support. So we have an event here, price slams through this support. Now, what happens when support is breached? We generally see it respected as resistance. Now, why I would not trade immediately after the move to the downside is because what you can see is following the liquidity push here, you have very limited orders at this point here. So what price can do is it can really whipsaw this support and create what's known as a bear trap. This is also something you could trade on a retest of that support at this point here. But this point here is why I would avoid trading the news. If you're based technically, is avoid trading the news post-event, 10 to 20 minutes post-event, because as I said, you can see a strong whipsaw. This is what I was referring to as a stop run. This is a bear trap. So we know traders will be entering long at this point here. We know their stops will be here. So a stop run to grab that liquidity, to buy into, is common around well-defined support and resistance levels. Now, do yourself a favor and look at the round numbers. So the RNs during news events, you will often see this occur. So you will often see a sharp move above a round number to collect the stops and sell into those stops. So this is what's known as a stop run, but we can also refer to this as a bull trap in this case. This case here was a bear trap. Okay, so let me just clear those drawings. So this is something to be aware of. Watch for clear stop run scenarios. And technically, if you're basing your method on purely technical analysis, I would always wait post event instead of prior to the event, because we just can never tell if you're just trading based on technicals. All right, so guys, thank you very much for taking the time out of your day to join me. There will be another webinar this next week, and that's trading strategies for beginners. And this is part 2 of this will focus on swing trading. So I will talk about central bank policy divergence, and I will focus on the technical side of things as well. If there are any specific topics you would like the team here to talk about, or questions related to this presentation, please be sure to send in your suggestions to either marketanalyst@fpmarkets.com or support@fpmarkets.com. Look, guys, we also have the FP Markets Trading Hub, and that's packed with educational articles and analysis. You can use that to further your education. We also have the Trading Academy, full of videos, full of in-depth articles as well. So be sure to check out those avenues. Okay, guys, thank you. This is pretty much all I have time for today. Thank you once again for taking the time to join. I hope you're able to walk away slightly more informed. Yeah, I'll catch you all bright and early next week. Thank you so much.